We have a lot of news to get through, so let's get right to it. Let's start with capital gains. We'll look at this great article from Stories entitled "What's Going On with Capital Gains? An Expert Explains." Did they mean to rhyme that? Oh, I read it wrong. What's going on with the capital gains tax? An expert explains.
I liked your way better.
Yeah, that was very Dr. Seuss.
So, chartered professional accountant CPA Vice President John Oakey says that while the CRA is moving forward, the new inclusion rate is still not official law. At the end of the day, is the taxpayers making the decision on what they're going to do, and there's consequences on either side of the fence, he said.
After it was initially believed the Liberals' capital gains tax increase would leave Parliament along with Trudeau after failing to be officially signed into law before the Prime Minister's resignation and prorogation of Parliament, a press release from the Canada Revenue Agency, or CRA, is now saying otherwise. Early Tuesday, the CRA announced that although the capital gains tax changes are subject to parliamentary approval consistent with standards practice, the CRA is administering the changes to the capital gains inclusion rate effective June 25th, 2024.
Here are a few more points about the current capital gains tax situation that you should be aware of. The CRA is moving forward with implementing that new 67% capital gains inclusion rate up from the 50%. That will be in effect June 25th, 2024. It's not officially law yet, but prepare for it. And us, Canadian taxpayers, face a choice: file at the current 50% rate and risk penalties if the law does pass, or file at the new 67% rate and potentially get a refund if it doesn't pass.
So there's a couple of key dates here and also a key change to this that literally just happened, Nick. Like, we're recording Thursday, January 16th at 11:20ish a.m. and there's an article that came out like, I don't know, 10 minutes ago, maybe an hour ago that I'm just going to pop in here. But
Amazing. So
so
this really does constitute as breaking news then, I guess.
yeah,
I mean,
somehow in a
it would have
format
already
that's
broke.
pre-recorded, yeah.
Yeah, exactly. It's breaking news for
Um
us live.
Yeah, so forms will be available on canada.ca by January 31st, 2025. CPA Canada believes legislation is unlikely to pass before April 30th tax filing deadline, and the situation remains uncertain due to the pending parliamentary approval, political uncertainty, and potential government changes, which I'm going to get to in a second, and the CRA proceeding based on Parliament's last stated intention to implement these rules despite current political uncertainty. And now, as of January 16th, Pierre Poilievre pledged to reverse the Liberals' capital gains tax if elected, which I've long speculated he wouldn't do because I felt that his government, just as much as the Liberal government, is going to need that income. But I'm wrong, and so
What?
yeah, I
You
know,
wrong? Come on, man.
happens pretty often actually, but I try not to tell people. But yeah, so Conservative leader Pierre Poilievre on Thursday promised to reverse the Liberal government's controversial changes to capital gains tax if he takes power at the next federal election, which seems pretty likely. He made a post on X. I'm announcing today, common sense conservatives will reverse last June's Liberal tax hike on capital gains. A tax economist will agree will kill 400,000 jobs. This liberal
Wow.
jobs tax was a bad idea before President Trump's tariff threat. This is outright insanity now. So obviously he's touched, and actually the tweet came out at like 4:32 a.m. So respect to that. But
He must be up doing the Mark
so he's
Wahlberg
sending,
style workouts.
yeah, just
Get
sending
up,
it.
cold plunge, right policy,
Yell at
tweet about it.
politicians on the internet.
Yeah. Yeah, I mean, look, I don't have much else to add to that. I think the capital gains, Dan, when we covered it months ago, I believe it was back in April and May, we released an episode of 2024 when it initially came out. You know, it was met with some controversy, and it obviously is still just as controversial. So there you go. Make your choice: file now or file later. Both have consequences. Let's keep moving here, Dan. Let's move on to interest rates. After a roller coaster couple years for interest rates, where do we see them going this year?
Well, to be honest, it doesn't really matter where we see them going because I'm a realtor and you're a mortgage broker. It matters a lot more where the banks who actually lend the money see them going. And even that doesn't really matter because they and the bond market are typically wrong, to be honest with you. If you look at the bond market forecast for what rates are going to do, they aren't exceptionally accurate. And when you look at the big six banks and their forecast on what rates are going to do, they're not exceptionally accurate either. But alas, we're going to look at them anyways.
I thought we might. And you're exactly right, man. Look, the economy will economy and it will do its thing. And the Bank of Canada, who's the only one that can make a meaningful reactionary impact on interest rates, will do its thing. But regardless of all that, we are going to look at what the big banks have to say, and we'll look at this great article with some graphics from Canadian Mortgage Trends, which is titled "Bank of Canada Rate Hikes in 2026. National Bank Thinks So." So just when Canadians thought the Bank of Canada rate hikes were behind us, one major bank is now forecasting the return as early as next year. That next year being 2026. In its latest forecast, National Bank of Canada predicts that the BOC will cut its policy rate by 100 basis points, so 1 full percentage point this year to 2.25% before then pulling the old switcheroo, the old bait and switch, the old Kansas City shuffle, and going right back to what it's been doing, to what it was doing for a while, which is hiking rates. So we've got some cuts and some hikes. They expect a 50 basis point hike as early as 2026, Dan.
Yeah. Crazy to see that on the chart. I mean,
I
I guess they would
know.
be, USCP. I wonder if the US CPI release today, because bond yields dropped pretty significantly because US inflation is coming down. You know, the I wonder if that would change their outlook now, because you really only would be predicting rates have to go up if we're anticipating seeing an inflationary environment. Tariffs could be inflationary, but it seems like the U.S. is no longer in that risk of inflation, at least for the time being. January of 2024. Let's go through the key points from National Bank's forecast and mortgage outlook. So, interest rate predictions: Scotia is expecting rates to stay at 3%. Other major banks forecast cuts, but haven't predicted any future hikes. The lowest is RBC, expecting a 2% overnight rate.
Did you notice the funny thing about this visual here, Dan, is that BMO and RBC were just like, yeah, we're not predicting Q anything in
Yeah, yeah,
2026. They just stopped after 2025.
yeah. I mean,
It's
that's
great.
reasonable, to be honest with you.
Yeah, I mean that
Yeah.
was what I would be doing, but I love the boldness of Scotia National Bank and TD and CIBC.
Yeah, so let's understand the rationale for these rate changes, anyways. So the economy needs stimulus due to potential below GDP growth, reductions in GDP growth, maybe even declines in GDP in an actual technical recession. Lower rates will help cushion the impact of mortgage renewals, which are coming up this year. And I've been long saying that was really going to be a policy objective of the Bank of Canada, was to relieve some of that pressure on households that were renewing, because we have, I think you said something like 60% of mortgages will renew in 2025 and 2026,
Mm-hmm.
according to this. So there's obviously a clear incentive. National Bank also forecasts unemployment to rise to 7% from the current 6.7% due to job growth lagging population growth. I would completely agree with that. I think that National Bank's been very correct in their calls. I really like their analysis. Their
Yeah.
national housing affordability monitor on a regular basis. We've covered it many times on the show. Um, I think I would, other than the rate call that they made here, I think I've been pretty much in agreement with them, and I just don't see an inflationary scenario on the horizon, um, unless tariffs really take hold. We do see a trade war, and it leads to like an inflation or stagflation world, which then NBC could be correct.
Yeah, no, that those are great points, and I do agree. I'm looking at this graphic right here, and I can see myself as more of a Scotiabank guy, just a nice 3% rate all the way through, right? I don't think we need any more volatility. But let's stay on the topic here, Dan. Let's talk more about rates and the mortgage environment, but this time we're going to focus on a specific mortgage product, the variable rate. This type of product has left a bit of a bad taste in the mouths of many Canadians who opted for it when rates were at all-time lows, only later on, unfortunately, to get stuck with much higher payments when rates went through that historical aggressive hiking cycle.
Yeah, so let's take a look at this article from Yahoo Finance to see their perspective on the variable rate this year. It says 2025 could be the comeback year for the variable rate mortgage. With interest rates on the way down, 2025 could see further resurgence in interest rates or in interest for the variable rate mortgage. We can safely expect that we'll see some downward movement on the variable rate side, whereas things are going to get a little stickier on the fixed rate side. Penelope Graham, mortgage rate expert at ratehub.ca, said in an interview with Yahoo Finance Canada. Variable rate mortgages move with the prime lending rate, which is affected by changes in the Bank of Canada's policy rate. Fixed mortgages are affected by the bond market, which has seen yields remain very, very sticky. Graham notes. Other than what we noted today, they dropped pretty significantly after U.S. CPI data came out lower than expected. So U.S.
Mm-hmm.
inflation is lower than expected, and it's been dropping bond yields pretty much across the country. Since October 1st, yields for the 5-year benchmark bond have been in the range of 2.74 to 3.31%.
Yeah, the mortgage interest rates have been on a wild ride, but of course so has the bond market, and that's obviously come up numerous times on this show. Let's go through a couple more of the kind of key points and takeaways from the mortgage outlook here, and this kind of deeper dive into the variable rate. So here's some key points. Fixed rates, right? No major movement expected in the first half of 2025. That's without significant market changes. So if we do see some major stuff happen, right, like the tariffs, or we're in for a lot of new political drama, I'm sure, on both sides of the border here. So without any significant market changes, no major expected changes. The 3-year fixed term is expected to still remain popular. It really has been one of the more popular products. Now, on the variable rate side of things, interest in variable rate mortgages have been increasing again as the Bank of Canada has continued to cut rates, and they're expected to fall below fixed this year. They're actually not far off, as of today. And some borrowers are accepting higher short-term rates, anticipating that future decrease, right? So you take that variable rate now, might be point or any 1 to 2 points higher than a fixed in some cases. However, if you're looking at that same chart and you're a fan of, let's say, BMO or National Bank or RBC, who are all putting rates between 2 and 2.5%, you may be on the right side of that. So, and Dan, anecdotally, at our shop, at our mortgage shop, we have seen a much more of a swing back to that variable rate, as well as whether people are choosing it a lot. It's coming up in conversation a lot more than it did for a while.
Yeah, it is funny because Canadians are just really bad at timing stuff. So like, they would jump it, they would pile into the variable when it's like at the low, not when it's gonna go to the low and you get the benefit of pricing and the decrease. So that's kind of funny. But anyway, let's move on here. If you're a longtime listener to the show, you've heard us talk about the HOPE acronym. If not, here's a quick refresher before we get to our next article. Economist Michael Kantrowitz's HOPE framework is our crystal ball for predicting the kinds of downturns that happen because of rising interest rates. And it's an acronym. HOPE, HOPE, lays out a simple sequence of events and how things play out in response to changes in the interest rates, not for positive and negative. Housing peaks first, followed by new orders, then companies' profits, and finally employment.